Hi guys, thanks for tuning in to another episode of Nuggets News. Today's off-the-cuff style video is going to be about trading psychology and how good traders think, how the market thinks as a whole, as well as some individual mistakes that beginners often make, and things that good traders do to produce a process that's repeatable over time to continually make money. So if you followed my work, you know that I've got a bottom-up approach to making money in crypto that revolves around doing fundamental research and analysis. The next most important layer is trading psychology. So where the market sentiment is at as a whole, as well as your individual emotions and sentiment, and how to control those when trading or long-term investing. And the final layer, I guess, or the icing on the cake, is technical analysis to look at specific price points or market action. So when diving into trading psychology, there's a few things that I think are really important to be aware of and that you need to acknowledge before you decide that you're going to participate in this space. And there's no doubt that this space is risky and more volatile than any other market in the world. And you've got to acknowledge that before you decide to jump in and throw your hard-earned money in that. And one of the sayings that I always say, respect your capital. And too many guys jump into this without a plan, okay? They just hear stories of other people making money and they just jump in the deep end and throw their money at things with no real plan or trading strategy. So we're going to dive into all that. So first off, if you want to make money in this space, I believe that if you want to be able to execute effectively over time, you need to be aware of trading psychology and you need to control your emotions. So we're all only human. Now, we are hardwired with those fight or flight inbuilt responses. And when markets go up, we all get that adrenaline rush. When we see the green on the screen, we get excited, okay? And that's what creates that FOMO, and we've all seen that bubble sentiment chart, when euphoria at the top of markets and disbelief at the bottom. And it is, no matter how many times you see that chart, it is still hard to control your emotions when we get a big run up in price, and it's hard to step in and buy when prices are falling. So that's your hardwired human emotions giving you that adrenaline on the way up and that fight or flight response on the way down. When you go into that fear mode or self-defense mode and you're hardwired, your brain is telling you to take action. So that's why a lot of people buy at the top and they sell at the bottom, because their emotions are getting the better of them. So that's the first thing I wanted to talk about. So we've all got that little inner voice in our head, and we need to, as in anything at life, you will get better at trading. So I tell a lot of guys, and I do a lot of one-on-ones with people, to think of this as running a marathon. You're not going to be good at it straight away, and you've got to respect the fact that when you do your first trade, your first investment, everyone else in the market has done more than you when you put on your very first trade. So you've got to respect that you're just a small fish in the ocean, okay? And these markets are powerful, okay? They're volatile. They don't wait for anyone. They'll chew you up and they'll spit you out. Okay, the markets don't care about your account going up or down. They will do what they want to do. So you've got to acknowledge all those things before you just jump in and think that you're going to make money, okay? And you've got to prepare yourself that when you buy something, the chances are that it's going to go down in price at some stage. Now, if you can tell me that everything you've ever bought has only ever gone up in price since, and at no point has ever gone down, okay, you can come work for me, because that doesn't happen. So by simply thinking about it from that point of view, you're already preparing yourself for the fact that at some stage, something you invest in is going to go down in price, and how are you going to react when that happens? And that's why we talk about doing your research in the first place, and that gives you that conviction to know that you've bought something good and that you're happy to hold it. Whereas if we're just buying on pure emotions, okay, and riding that roller coaster, it's very easy to come undone and lose control of your trading and your investing. So that's why we have sayings like only invest what you're willing to lose, okay? accept the risk, accept responsibility. No one else is responsible for your money at the end of the day other than you. So that's why it's important to have a plan, okay? So not everything is going to go straight up. It's important to have a plan of exit even when you enter a trade. Are you buying these things for the long term? Are you buying this as a day trade or a swing trade? So formulate at least some sort of plan that'll help you control your emotions and dictate when you buy and sell. So often we hear those stories of riches, and that's why a lot of people jump in straight away, but a lot of the time they are the exception, not the rule. And as in gambling or anything in life, we always hear the good stories, but trust me, there's equal amount of bad stories that don't get disclosed on social media, and I'll talk about that a little bit at the end. So a lot of people enter this with unrealistic expectations to get rich quick, and that affects the way they trade. So if you put on a losing trade, so many people have this mindset that, right, I've got to get my money back on the next trade, and that brings about what we call suicide trading. So you lose 50% on a position, you've got to actually make 100% on that next position to break even, and people go all in on the next trade. They trade too big, okay, and that's not repeatable. That's not a process that's going to steadily make you money over time. So that's the next thing I want you to try and get your head around. So a lot of people in this space have only been in the market since it's gone up. Now, we've got these overnight experts coming out of left, right, and center that are posting technical analysis, telling you which coin's going to the moon next. It's so hard now with the internet and social media to know who is well qualified and who has been in this game for a few weeks and posting charts up. And like I said, at the end of the day, you're responsible. So you've got to be really careful who you're following as well in this space. So, a lot of people are about to get a real harsh reality check. Everyone thinks they're a good investor when things go up. But once we enter a bear market or a downturn or sideways action for an extended period of time, a lot of people are about to get a real reality check. And that's when experienced traders rise to the top and when other guys are going to get bored or throw in the towel, okay? Right, so the next thing I want to talk about is emotional capital. So just like you've got your capital, your money that you allocate to trading or investing, and we talk about being diversified, think of your emotions as a pool of capital, and you're not ever going to put all your emotion into one position or all your emotion into cryptocurrency. Trading needs to be, or investing, a healthy part of your life, just like anything else in life, okay? You need to have a healthy balance. So you need to have time away from the markets each day. You need to know when you're overcommitted and realize that it might be affecting your other relationships, and then in turn those relationships come back to affect your trading when you're trying to get that money back because you've had a fight with your spouse about losing money and all those sort of things. So if you're angry at work and you come home and expect to be able to trade well with a clear mind for 2 hours each night, okay, you've got to realize that all this is a balance. And I've done videos about how to trade wild swings where I talk about you've got to decide whether or not you're going to even trade this or sit out these wild swings and just hodl, as the saying goes, because these markets are so volatile. And it's probably a good intro to the story of people that lose money in this space, even though they've got in early. So we all hear the stories of the guy that threw 10 grand at a coin and now it's worth 100 grand a few weeks later. But there's the stories that I like to listen to and the stories you need to learn from are the ones where guys bought 1,000 Bitcoin 4 years ago and now they've ended up with 200 Bitcoin. They've lost 80% because they thought they were going to trade these swings and build their account. And as their emotions got the better of them, when Bitcoin went from $3 to $10, they sold some because they didn't have a plan, okay? They're just seeing the green on their screen and selling. And then again, when it falls down in price, they panic and think, oh, I've made good money now. And they gradually wear away and lose their account over time because they're not aware of their emotions and they don't have a long-term repeatable strategy or plan in place. So I guess the next thing I want to talk about is focusing on the plan rather than the profits or the your winnings. So rather than people say, do you take profits at 20%? Well, to me, it's more about if you enter a trade or an investment with the idea that that's going to do well over a set period of time, if the price starts to go up and our assumption starts to play out, we don't take it off just because it's doubled or tripled, or even if it's gone up 10 times in price. That's not a good reason just to take it off if your assumption still hasn't been reached yet. If you bought a coin because you thought it was going to do really well in 3 years' time, no, there's nothing ever wrong with taking some profits and rebalancing your portfolio, but a lot of people click the sell button and they sell all at once, and when they've actually got in early on a really good project that other people are only just starting to discover. So you've got to think about all those things and formulate that exit strategy rather than letting a bit of profit dictate your thoughts and your actions. So this is all part of that trader psychology to becoming a good, rounded, overall investor. So making money actually isn't that easy. And as I said, we all hear stories of the guy that bought early, but so many of those guys have sold early as well. So it's not easy to make big amounts of money. It is very hard. It's mentally taxing. And I've been through 4 big market cycles since I got in these markets in 2012. And every time it is still hard. So when Bitcoin and Ethereum fall from their all-time highs a couple of months ago, 60, 70%, it is still hard. And there's still that little voice in your head that says, maybe this is all over, okay? You've got to fight that voice. You get better at it over time. Like running a marathon, you're going to build up your trading psychology and improve the way you can control your emotions. So the next thing I want to talk about is not becoming the trade. So a lot of people feel that the trade or their account balance represents and becomes their self-worth. So if you make a good trade, everyone wants to post on social media. But if you make a bad trade, everyone wants to kick themselves and beat themselves up and make that trade personal. Now, you need to get to the point where you've got a plan in place, okay? And successful traders only need to win more than 50% of the time, or not even that. If you've got 40% losing trades but 10% breaking even, and you control your position size, you're diversified, you shut down losers, and you let your winners run to the right levels, okay? At the moment, there's a lot of guys in this space that have only been in this bull market, and I know personally the last few months we're striking at 100% for trades and coins we're investing in. And as I said, the true test is yet to come when we get a downturn in this market. So think about all that stuff about having that repeatable process, and are you prepared for if we get a downturn, or are you just striking it lucky because we've been in a bull market? So that plan becomes really, really important, and you need to get to the stage where you're congratulating yourself on closing a trade that's a loser because you are doing the right thing and sticking to your process, rather than beating yourself up or saying, I'm just going to wait for this to break even and then I'll get out, or I'm going to double up and make my money back on the next trade. You need to congratulate yourself if you're sticking to the plan for closing down losers, because we're never going to win 100% of the time. Now, I guess the final thing is self-reflection. Once we've done all this and you're aware of your emotions, take some time to go for a walk, clear your head, okay? Maybe even if it's only once a month, do something that completely clears your mind and think about your trading process and if you're improving, if your plan's working or does it need to change. You may have had a week of all losing trades, but if you stuck to your plan, maybe there's 3 weeks of winning trades coming around. So self-reflection, taking that time to work out what's working for you and what may need to be improved or changed in your personal strategy. So making money is not easy. It's not as rosy as everyone's presenting at the moment in these bull markets. Okay, I do a lot of work with this sort of stuff in my private group and one-on-one with people, and those links are down below if you're interested. But I hope you guys have enjoyed this video. If you want me to dive in deeper on any specific topic in trading psychology in the future, let me know. But as always, guys, please give this video a like, share it around, subscribe if you haven't already, and as always, thanks for tuning in. Cheers, guys.